Warren Buffett, the man who turned $10,000 into over $100 billion, is one of the most successful investors in history. But here's the twist: he's not a risk taker. In fact, many of the things he'd never do with money might shock you. Did you know Buffett avoids investing in tech companies, even though they've made many investors rich? Or that he's never taken out a loan to buy stocks, even during the biggest market crashes? His approach to money is the complete opposite of what most people believe leads to wealth. In this video, we'll dive into the 6 things Warren Buffett would never do with his money, and why his choices could help you avoid costly mistakes. Stick around to find out how his principles can change the way you think about investing. Chapter 1. Chasing quick wins? Not Buffett's style. Warren Buffett is often quoted saying, "The stock market is a device for transferring money from the impatient to the patient." He believes in patience over quick gains. Buffett's approach is rooted in long-term investments, not speculation. Unlike many traders chasing short-term profits, Buffett buys businesses he believes will thrive for decades. Take Coca-Cola, for example. He bought it in 1988 for $1.3 billion, and it's since earned billions more. That's over 30 years of steady growth. The difference between quick gains and steady growth is a mindset. Buffett avoids high volatility stocks that could make investors emotional. Instead, he chooses companies with predictable earnings and a solid future. He once said, "Our favorite holding period is forever." This mantra isn't about avoiding risk, it's about understanding it and staying patient. Buffett's investments usually focus on sectors like consumer goods, banking, and insurance, industries that have stood the test of time. According to him, quick wins are a gamble, while long-term success is a strategy. When you think long-term, market fluctuations don't feel as scary. The key to Buffett's success is consistency. If you want to build wealth, don't rush it. Time in the market, rather than timing the market, is what truly pays off. Quick wins? They're just distractions for Buffett. Chapter 2. Betting on fads? Buffett knows better. Buffett is never interested in the latest trend. He's been very clear, he won't invest in a company he doesn't understand. Fads come and go, but solid businesses last. This is why Buffett avoided tech stocks in the 90s, even though they were the hot ticket. When people rushed to invest in dot-com stocks, Buffett stayed clear. In fact, he famously referred to the dot-com boom as the greatest bubble in history. He didn't care that tech companies were soaring, he was focused on real, durable businesses. Buffett has said, "We simply attempt to be fearful when others are greedy and to be greedy only when others are fearful." It's a strategy that requires ignoring the noise. Fads often distract people from looking at real value. It's tempting to jump in when everyone is buying the next big thing, but Buffett reminds us that steady, reliable businesses win in the end. Instead of chasing fads, he's focused on industries with a stable demand. Look at his investment in See's Candies. He's had it since 1972, and it's still going strong. A fad might promise big returns, but those returns are rarely sustainable. Buffett's portfolio is built on brands that don't need to chase trends because they already have loyal customers. His approach to business is simple: invest in what you know, and make sure it has staying power. Chapter 3. Ignoring risk? Buffett's risk aversion secrets. Risk is a key part of investing, but Buffett has a unique way of handling it. He's not afraid to take calculated risks, but he avoids unnecessary ones. His rule of thumb is straightforward: don't lose money. One of the most famous quotes from Buffett is, "Risk comes from not knowing what you're doing." For him, understanding what you're investing in is the best form of risk management. He'll never invest in a company unless he truly understands its business model. This cautious approach has led him to avoid many industries, like tech or biotech, which require a high level of specialized knowledge. Buffett's rule of circle of competence reminds us that staying within what we know reduces risk. But it's not just about knowledge. Buffett also stresses staying financially disciplined. He believes in having enough cash on hand to weather any storm. During the 2008 financial crisis, Berkshire Hathaway's cash reserve helped them scoop up undervalued companies. By keeping cash available, Buffett had the ability to act when others were too fearful. He's also cautious with debt. One of the reasons Buffett avoided high-risk investments during the housing bubble was because he knew how much leverage was involved. His ability to assess risk, whether it's financial or market-related, has been critical in protecting his wealth. If you're enjoying these insights, don't forget to hit subscribe for more content on how to think like Buffett and improve your investing strategies. Chapter 4. Betting on Debt? Buffett's never been a fan. Warren Buffett is known for his aversion to debt. While many investors leverage debt to increase their returns, Buffett keeps it simple. Avoid unnecessary borrowing. Buffett has said, "The chains of habit are too light to be felt until they are too heavy to be broken." This is his warning about the dangers of relying on debt. Many investors don't realize how quickly debt can snowball. Buffett's perspective is clear. Companies with heavy debt are riskier. During the 2008 recession, Buffett used his cash reserves to buy distressed assets. He was able to purchase companies with strong fundamentals, but without the burden of debt. Debt can quickly eat into profits, and Buffett doesn't like anything that could threaten his investments. He prefers companies that have a strong balance sheet with minimal debt. For instance, he's been vocal about the importance of focusing on companies with solid cash flow. A company's ability to generate consistent profits is a key part of Buffett's investment criteria. By avoiding debt-heavy businesses, Buffett minimizes his risk and ensures a steady income stream from his investments. As Buffett has often said, we always focus on businesses that can generate cash without needing to borrow. And that's how he avoids the stress and pitfalls of high-risk financial leverage. Chapter 5. Following the herd? Buffett breaks away. Warren Buffett is often seen as a contrarian investor. When the market is fearful, he's often buying, and when it's overly optimistic, he's cautious. He avoids following the herd mentality, which is one of the reasons he's been so successful. One of his most famous quotes is, "Be fearful when others are greedy and greedy when others are fearful." Buffett doesn't fall for the emotional highs and lows of the market. During the dot-com bubble, for example, he didn't jump into the tech craze. Even when the market was surging, he stuck to his disciplined strategy of buying companies with real value. His ability to swim against the tide has paid off time and again. For Buffett, it's all about doing the opposite of what the crowd is doing. When everyone is selling during a market downturn, Buffett is buying up companies at a discount. This contrarian approach has helped him avoid the mistakes that many investors make by chasing after the latest trend. It also means that Buffett doesn't worry about short-term market fluctuations. The key to his strategy is that he doesn't let other people's opinions sway him. While others panic, he stays calm and sticks to his investment principles. Chapter 6. Underestimating the importance of management? Buffett's golden rule. One of the key elements of Warren Buffett's investment strategy is his focus on company management. He's often said that when choosing investments, he looks for good people in good businesses. A company's management is just as important as its products or services. Buffett wants leaders who are not only skilled but also ethical. He's invested in businesses with great leaders, like Coca-Cola's CEO, and he's walked away from those with poor management. He once said, "When a manager with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact." This is why he's so particular about who runs the companies he invests in. If a company is poorly managed, no amount of good products or services will turn it around. For Buffett, integrity is key. He values honesty and transparency in management. This focus on leadership has served him well, as many of his most successful investments have been in companies with strong, ethical management teams. Buffett's belief in the importance of good management means that he's willing to pay a premium for well-run companies. It's not just about the numbers, it's about the people behind them. Good management can turn an average business into a successful one. And Buffett's success is a testament to his belief in the power of great leadership. If you're interested in learning more about Buffett's strategies and how you can apply them to your own investing, make sure to subscribe to stay updated on future videos.